To the second segment of our business right here on PM News. Good afternoon to you. In case you've just tuned in, money lenders have warned homeowners to urgently start preparing for higher interest rates and making provision to minimize the impact. Better Bond Home Loans CEO Shaun Rademeyer says it is envisaged that interest rates will gradually increase over the next few years. Rademeyer says the prime interest rate is 0.7%, 5 points higher now than it was at the beginning of the year. And he has advised homeowners to assess whether they'll be able to afford higher repayments. And in the meantime, its assessment of the current property and household market, FNB says the areas formerly classified as Black Township Areas under Apartheid Era classifications marginally outperformed the former white suburbs in terms of house price growth in the third quarter of 2014. Like the suburban markets, they reflect a good balance between demand and supply, but certainly not demand far outstripping supply, which would lead to the boom time price inflation. To discuss this, we are joined in the studio by John Loos, who is household and property sector strategist with First National Bank. Thank you very much for joining us.
It's a pleasure, Colin.
Should there be a cause for concern for homeowners regarding the projection of the hike in interest rates and whether or not they'll be able to afford?
I think the well-prepared homeowner, probably not. The indications are that the Reserve Bank wants to move very slowly on interest rate hiking, but I think the risk is there that we need to move higher in interest rates. We've got a big current account deficit, which requires big foreign capital inflows to fund it as a country. If those capital inflows aren't there anymore because of the US starting to hike interest rates, perhaps next year, it can put more pressure on the rand, and that can become more inflationary. So the risks are there. The Reserve Bank wants to move slowly, and I think it's prudent. As I say, the well-prepared household should probably not be concerned, because the well-prepared household would have made provision for a couple of percentage point interest rates hikes. That's the sensible thing to do. But if you haven't, and if you're really close to the edge with regard to financial pressure, it is time to start preparing, I believe.
Now, what can one do to avoid being financially constrained in terms of the current servicing of the debt and the projected increase, say, in the next 3 years, given that most of the time we cannot really hedge that against salary increases because they are negotiated on a yearly basis, and you wouldn't know how much percentage increase you would have to budget for the household income, especially disposable income?
Well, I think the one obvious thing one can do, if you can't afford to take too much in the way of punishment, is to fix interest rates. Now, fixed interest rates may not be that attractive anymore because the forward rate markets are starting to probably expect some rate hiking, but it's something worth having a look at. You can, for up to 5 years, fix that part of your cash flow, and you can sleep peacefully if you can afford that fixed rate. The other thing to really do is to start setting one's monthly payment at rates considerably above where it's required, so that it would require a few percentage points worth of interest rate hikes before you'd have to pay more. And then what you started doing is adjusting your lifestyle accordingly to live within your means, given that new limit. And for a lot of us, there are a lot of things. I'm not talking about the poorest of the poor. As you get poorer, it admittedly gets more difficult to cut costs. But when you get up towards the middle class, there is a lot you can do in terms of cutting what are non-essential expenditures other than food and transport and the basics. The really most extreme, if you really are under significant financial pressure, the more extreme measures are selling your house, downscaling to something cheaper. It's amazing how that can cut the costs. The house is probably the single most important driver of costs. Insurance costs, rates and electricity, maintenance, a lot.
But John, let me come in there. It is rather costly to sell a house nowadays.
Absolutely.
In terms of expecting to gain profit from its market value accumulation.
It is. So ideally, if you aren't in the position that you've bought yet, you need to think very carefully and buy well within your means. I think that's the best thing to do. Some people are past that and they are under financial pressure, and then you just have to sometimes bite the bullet.
And there are penalties involved as well?
For cancelling a home loan?
Yeah.
It shouldn't be significant. You can pay off. There is some cancellation fee, but it's minimal. Paying off a home loan in advance is not penalised normally. But a house, and it's unbelievable how many costs come with a house. And if you go from house number X to one that's half the size, you can cut down on the maintenance and running costs quite dramatically. So that's the radical measures that people can take. It's, you know, it's not ideal. It's quite traumatic for some people to do that, but it is possible if you really need extreme measures.
Okay, give us an analysis on the trend that's going on. People now are looking at investing in property. Say, for example, if they were living in standalone houses, they go for townhouses and rent them out so that they can make income in the meantime. And others go for township houses, but in terms of value accumulation and the current value cost, they go around 300,000. And when you look at townhouses in suburbs, they go around $500,000 and all that. So what is this trend in terms of comparisons of former apartheid era township houses and the current former white suburbs properties?
Well, you probably, for a start, you'd probably get better income yields in the township properties. Generally, the lower down you go in terms of price, you probably get to better yields, but we don't have an up-to-date estimate of those. So that's, you know, from the income stream versus value point of view, those township markets are possibly more attractive. You've got to understand the market. You've got to understand tenants in various markets you deal with. They vary right across the spectrum. So there's a bit of homework to be done no matter what market you play in. But as you go down, the yields probably get better. Capital growth, the price growth, 9.5% average we calculate for the township, slightly better than the overall metro averages of 7%. They have been playing catch-up in recent years.
I'm hard-pressed for time,
Sure.
and I wanted to ask you this question about most of the townships you would have a double-story house in the middle of four-roomed houses and all that. What does it do to the value of those smaller houses, and can there be a property value accumulation in terms of that big erection of that property?
In certain places, you may overcapitalize by building a big double-story property in the middle of a lot smaller. You're out of line with what the general market in that area may want. Not all townships, but in some, in many. And if you're overcapitalized, the chances are that investment in those big upgrades, you're possibly not going to get back when you sell the house. It's ideal to be in line with the market or possibly undercapitalized.
Okay. I think that we'll make time for that discussion in our next interview when we discuss it. All right. That's John Loos, Household and Property Sector Strategist with First National Bank. We will get back to that subject again in our next analysis of the property market. Let's go on and on to other news now. World leaders, including